Welcome to CandiMentor. Today, let's decode the top balance sheet reconciliation interview questions you need to ace your next job opportunity. It's crucial to understand these concepts as they play a vital role in financial accuracy and integrity. Whether you're a seasoned accountant or a budding financial analyst, mastering these questions is your gateway to success. Stay tuned for insights that will elevate your interview preparation and career trajectory. Let's dive right in. What is balance sheet reconciliation? Balance sheet reconciliation is the process of verifying and ensuring that the balances presented in the balance sheet are accurate and complete. It involves comparing the general ledger accounts with independent sources like bank statements or vendor invoices to ensure consistency. This process is crucial for identifying discrepancies, preventing fraud, and ensuring financial statement integrity. Why is reconciliation important? Reconciliation is important because it ensures financial accuracy, reduces the risk of errors, and confirms that transactions are recorded correctly. It helps to detect unauthorized transactions, prevent fraud, and maintain the credibility of financial reports. Accurate reconciliations also support informed decision-making by providing a true financial picture. What are the key steps in balance sheet reconciliation? The key steps include identifying the accounts to reconcile, gathering supporting documentation, comparing balances, identifying discrepancies, and making necessary adjustments. Finally, documenting the reconciliation process and obtaining approval is essential for accountability and audit purposes. How do you handle discrepancies found during reconciliation? Handling discrepancies involves investigating the cause, which could be due to timing differences, errors, or omissions. Once identified, corrective actions such as adjusting journal entries or contacting counterparties to resolve discrepancies are taken. It's crucial to document these actions for future reference. What tools or software do you use for reconciliation? Common tools include Excel spreadsheets, ERP systems like SAP or Oracle, and specialized reconciliation software like Blackline or Reconart. These tools help automate the reconciliation process, reduce manual errors, and increase efficiency by providing real-time insights and audit trails. Explain the role of a trial balance in reconciliation. A trial balance is a report that lists the balances of all general ledger accounts. It's used in reconciliation to ensure that debits and credits are balanced. Any discrepancies in the trial balance indicate errors that need to be examined and corrected before finalizing the financial statements. How do you reconcile bank statements? Reconciling bank statements involves comparing the bank's records with your company's ledger. You check for differences in deposits, withdrawals, and balances. Adjustments may be needed for outstanding checks or deposits in transit. This reconciliation ensures that cash records are up to date and accurate. What are some common challenges in reconciliation? Common challenges include missing documentation, timing differences, manual errors, and complex transactions. These can lead to discrepancies that require thorough investigation. Effective reconciliation requires attention to detail, strong analytical skills, and sometimes collaboration with other departments. Describe the importance of timeliness in reconciliation. Timeliness in reconciliation is critical to ensure that financial data is current and accurate, allowing for proactive financial management. Delays in reconciliation can lead to outdated information, increased risk of fraud, and financial decision-making based on incorrect data. How do you reconcile intercompany transactions? Intercompany reconciliation involves matching transactions between entities within a group. It requires verifying that accounts receivable and payable between entities are consistent. Differences are resolved through internal adjustments, ensuring that consolidated financial statements accurately reflect group activities. What are adjusting entries, and how do they relate to reconciliation? Adjusting entries are journal entries made to update account balances before finalizing financial statements. They ensure that revenues and expenses are recorded in the correct period. During reconciliation, discrepancies found may require adjusting entries to correct account balances. How can automation improve reconciliation processes? Automation improves reconciliation by reducing manual effort, increasing accuracy, and speeding up the process. Automated systems can match transactions, highlight discrepancies, and generate reports, allowing accountants to focus on resolving issues rather than data entry. Explain the concept of materiality in reconciliation. Materiality refers to the significance of discrepancies found during reconciliation. Not all differences require adjustment, only those that could influence financial decision-making. Understanding materiality helps prioritize which discrepancies to address, focusing efforts on those that matter most. How do you ensure data accuracy during reconciliation? Ensuring data accuracy involves cross-verifying with independent sources, reviewing transaction history, and using reliable software. Regular audits and maintaining a clear audit trail also help in identifying and correcting errors, thus maintaining data integrity. What is the impact of incorrect reconciliation on financial statements? Incorrect reconciliation can lead to misstated financial statements, which can affect business decisions, investor confidence, and compliance with regulations. It can also result in financial penalties and damage to a company's reputation. How do you stay updated with reconciliation best practices? Staying updated involves continuous learning through professional development courses, attending industry seminars, and participating in forums. Reading financial publications and engaging with professional networks also provide insights into evolving best practices and technologies. Can you explain the difference between reconciliation and an audit? Reconciliation is an internal process focused on ensuring account accuracy and identifying discrepancies. An audit is an external examination by independent auditors to verify the accuracy of financial statements and processes. Reconciliation is a routine task, while audits occur periodically. How do you prioritize accounts for reconciliation? Prioritization is based on risk and materiality. High-risk or high-value accounts are reconciled more frequently. Accounts with frequent discrepancies or those critical to financial reporting are also prioritized to ensure accuracy and reliability. What documentation is essential for reconciliation? Essential documentation includes bank statements, invoices, receipts, contracts, and previous reconciliation reports. These documents provide evidence for transactions and support for any adjustments made during the reconciliation process. How do you communicate reconciliation results to stakeholders? Communicating results involves preparing detailed reports that highlight discrepancies, adjustments made, and their impact on financial statements. Clear, concise communication ensures stakeholders understand the implications and can make informed decisions. Regular updates and transparency are key. If you found this helpful, don't forget to like, subscribe, and hit the bell icon for more insights from CandiMentor. Drop your questions in the comments, and let's master balance sheet reconciliation together.